Is former President Donald Trump attempting to exert pressure on the Federal Reserve, the central bank of the United States? This question is increasingly relevant as we navigate a complex economic landscape. And perhaps more importantly, what does it all mean for your wallet, your savings, and your financial well-being? How might these high-level political and economic maneuvers trickle down to affect your everyday life? This isn't just political drama playing out on the national stage. The Federal Reserve's decisions have a direct and significant impact on your mortgage rates, your future job prospects, the availability of employment opportunities, and the interest you earn on your savings. As elections rapidly approach, presidents and political figures often desire a robust and thriving economy to bolster their standing. Lower interest rates, a key tool of the Fed, can stimulate economic growth, encouraging investment and spending, create more jobs, reducing unemployment and increasing economic security, and generally boost the stock market, benefiting investors and retirees alike. Trump has consistently advocated for lower interest rates throughout his time in the political spotlight, arguing that they provide the U.S. with a competitive edge in the complex landscape of global trade and international finance. Now, with his potential political comeback very much in play and the election looming, his renewed calls for interest rate cuts carry even greater weight and significance. The Federal Reserve, therefore, faces a particularly delicate balancing act in the current environment. Should it respond to the increasing political pressure, or should it remain steadfast in its commitment to making decisions based solely on objective economic data and analysis? If interest rates drop, borrowing money becomes more affordable, which is generally good news for prospective homebuyers and individuals carrying significant credit card debt. Conversely, if interest rates remain elevated, the cost of borrowing increases, making loans more expensive, potentially slowing down economic growth, but simultaneously rewarding those who diligently save money. The Federal Reserve is fundamentally designed to operate with a high degree of independence from political influence, with the intention that its monetary policy decisions should be grounded in sound economic principles and empirical data, rather than political considerations. However, when that crucial independence is called into question or perceived to be compromised, financial markets tend to react with nervousness and volatility, and that's a situation that should warrant your attention and careful consideration as well. This is not simply a matter of a disagreement between Trump and the Federal Reserve. It's a fundamental question of how your personal financial future and the overall economic stability of the nation are being managed and safeguarded. The stakes are undeniably high, and the ultimate outcome of this interplay between politics and monetary policy will inevitably touch the lives and financial well-being of every American household. Next, let's delve deeper and break down precisely what the Federal Reserve does and how its actions impact the economy. The Federal Reserve. It stands as a cornerstone of the American financial landscape. America's central bank, a vital institution with a broad mandate. It was created to keep the economy healthy, fostering an environment of sustainable growth and stability. Its main jobs, its core responsibilities are multifaceted. First, to maximize employment, ensuring as many Americans as possible have access to jobs. Second, to keep prices stable, preventing runaway inflation or deflation that can harm consumers and businesses. And third, to manage long-term interest rates, influencing borrowing costs across the economy. While the Fed doesn't print money directly, it controls the money supply and credit conditions, influencing how much money is available in the economy and at what cost. Its most powerful tool is the federal funds rate, the target rate that banks charge one another for the overnight lending of reserves. This rate influences everything from mortgages to business loans, impacting investment and economic activity. Crucially, the Fed is supposed to be independent, insulated from political pressure, allowing it to make decisions based on economic data, not political expediency. This independence lets it make tough calls, like raising rates to fight inflation, even if it's unpopular in the short term. If the Fed's credibility is shaken, if people lose faith in its ability to manage the economy, markets and the economy can quickly destabilize, leading to economic downturns. A trusted, independent Fed is essential for a stable financial system and ultimately a healthy and prosperous economy. Trump's public pressure on the Fed isn't new. He criticized Chair Jerome Powell throughout his presidency for keeping rates too high. He argued lower rates would boost growth and help the U.S. compete. These calls have intensified as the 2024 election nears, raising concerns about the Fed's autonomy. Powell, meanwhile, has repeatedly defended the Fed's independence, insisting decisions are based on data, not politics. The Fed's public statements reinforce this, aiming to reassure markets and the public. The message: the Fed serves the American people, not any administration. Preserving this independence is vital for economic stability. If the Fed decides to cut interest rates, it essentially makes borrowing money less expensive. This is generally good news for homebuyers, as mortgage rates could decrease, making homes more affordable. It's also beneficial for car shoppers, who might find auto loans more attractive, and it can provide some relief for anyone struggling with credit card debt, as interest charges may decline. Businesses, seeing lower borrowing costs, may be encouraged to invest more in their operations. This increased investment can lead to the creation of new jobs and a potential boost in wages for workers. Historically, the stock market often reacts positively to rate cut news, with investors anticipating increased economic activity. However, there are inherent risks involved. Cutting rates too aggressively or prematurely can fuel inflation, potentially eroding purchasing power. It can also contribute to the formation of asset bubbles, where prices become detached from underlying value. Furthermore, if the Fed is perceived to be caving to political pressure rather than acting independently, it could severely damage its credibility in the eyes of the public and financial markets. This loss of credibility would make it significantly harder to effectively manage future economic crises. Economic history is replete with examples showing that when central banks lose their independence and become subject to political control, economies can quickly spiral into instability, with devastating consequences for citizens. Therefore, the short-term economic boost that might result from rate cuts could ultimately come at the expense of long-term economic health and stability. The Fed faces a delicate challenge: balancing the need to stimulate economic growth with the imperative to maintain price stability, all while safeguarding its independence from undue political interference. The consequences of the Fed's decisions regarding interest rates will be felt directly or indirectly in every household across the nation. If the Fed holds rates steady, borrowing stays expensive, but savers benefit. Markets may react with volatility, so financial advisors recommend keeping some cash handy and reviewing your budget. Don't make rash decisions based on headlines. Focus on your long-term financial plan. Diversify your investments to manage risk, no matter what the Fed does next. The core debate: should the Fed cut rates to boost the economy, or stand firm to protect its independence? Your financial future may depend on the answer. So, what do you think? Should the Fed yield to political pressure, or hold the line for long-term stability? Thanks so much for watching and joining us on this journey into the world of the Fed, the economy, and your wallet. If you found this video helpful, make sure to hit that subscribe button and turn on notifications so you never miss an update. We're here to break down the news and help you make sense of what it means for your financial future. Stay informed, stay empowered, and we'll see you in the next video.